I have always believed that the biggest mistake in investing is not paying too much for a stock. The biggest mistake is buying into something that never deserved your long-term trust in the first place. A lot of people think they are buying for the long run when what they are really doing is renting excitement. They are not owning a business. They are borrowing a theme. They are borrowing momentum. They are borrowing a hot quarter, a hot product, a hot slogan, or a hot chart. Then they call it conviction. That is not conviction. Conviction begins with a much harder question. If I lock this decision away and come back 10 years from now, will the business itself still be stronger, more embedded, and more necessary than it is today? I do not care how popular it is this month. If the answer is yes, then I want to know what gives it that durability. I want to know what keeps customers coming back. I want to know what makes competitors fail. I want to know whether management thinks in seasons or in decades. I want to know whether the brand means something or whether it is simply sitting on top of a temporary trend. When I think about businesses I could live with for a very long time, I do not start with a spreadsheet. I start with behavior. I start with habit. I start with the part of the world that people are unlikely to give up. Then I move to structure. Then I move to economics. Then I move to price. That line of thinking is why a company like Amazon earns its place in my mind. People like to describe Amazon as an online retailer, but that description is too small. Amazon has become a default behavior that matters more than a slogan and more than a quarter. When a business becomes the first place people go without thinking, it has crossed into very rare territory. A light bulb burns out, a charger breaks, a kitchen tool goes missing. A parent remembers a birthday too late. Someone needs a replacement filter, a book, a cable, a toy, batteries, paper towels, detergent, or 20 other things before dinner. They do not run a grand analysis. They open Amazon. That kind of habit is worth far more than a burst of demand. Habits become infrastructure inside a household. Once a company reaches that point, the customer is no longer deciding whether to use it from scratch every time. The customer is defaulting to it. That creates a very powerful kind of moat because the competition is not merely fighting on price. It is fighting against routine. The second thing that makes Amazon unusual is that it is not living on one engine. The retail engine is enormous by itself, but behind it sits AWS, and behind that sits advertising, and around all of it sits a management culture that has shown a willingness to spend heavily when it sees a platform being built. Many investors panic when a company spends aggressively because the near-term free cash flow looks weaker and the headlines sound expensive. But sometimes a heavy spending cycle is not a sign of indiscipline. Sometimes it is the toll you pay to own the next bridge. Amazon has done this before. It spent to build out logistics. It spent to expand warehouses. It spent to create delivery capability that would have looked excessive until the scale arrived. It spent on AWS before many people fully understood how central cloud infrastructure would become. Now it is spending heavily again around artificial intelligence. And I do not think the right question is whether this quarter looks neat. I think the right question is whether AI strengthens Amazon's existing flywheels. If it helps consumers discover and buy more efficiently, if it improves ad targeting, if it deepens the usefulness of AWS as a back-end for the next generation of computing, then the spending is attached to an already powerful system. That is very different from a business gambling on a completely foreign dream. And there is one more reason I take Amazon seriously over a period measured in decades. The economics still have room to mature. A business of that scale with multiple high-value segments does not need miraculous assumptions to produce much larger earnings later. It needs time, discipline, and continued relevance. That is a much safer bet than hoping a small company invents greatness out of thin air. From there, my mind goes to a much younger enterprise, but the logic is familiar. SoFi interests me because it is trying to become a primary financial home for a generation that expects its life to run through a phone. Many financial companies have products. Fewer have the chance to become the central relationship. There is an enormous difference between selling someone a product and becoming the platform they return to for borrowing, saving, payments, investing, refinancing, and identity inside the financial system. That is why I do not think about SoFi as a one-trick lender. I think about it as a digital financial relationship that is still in the process of deepening. If a customer enters through one product but stays for several, the value of that relationship expands far beyond the first transaction. In banking and consumer finance, lifetime economics matter enormously. The first win is not the whole win. The whole win is turning a user into a long-duration customer. I also like the fact that the company has tried to avoid behaving like an old-style institution, weighed down by every risk it originates. There is a practical intelligence in building a model that can distribute risk rather than swallow every piece of it. Asset-light thinking, when done carefully, can preserve flexibility. It can allow management to pursue growth without pretending that size alone is wisdom. And when I evaluate a company that is still relatively early, management matters even more. A business that is trying to build itself into a category leader over the next 20 years needs someone who is not merely managing the current quarter. It needs someone arranging the foundation brick by brick. I do not need perfection. I need direction. I need evidence that leadership understands that habits, trust, member growth, product breadth, and balance sheet prudence are all pieces of the same long game. If that remains true, then a company that looks small beside the giant banks today can still become meaningfully larger and more powerful over time. Then there is Meta. And Meta reminds me that scale can still be misunderstood, even when it is standing right in front of people. A great many investors spend too much time worrying about whether a social platform feels fashionable to them personally, and too little time asking what it means to operate several of the largest communication and attention systems on Earth. When billions of people use your products to message, scroll, discover, follow, and communicate, you are not simply running an app. You are operating a digital habitat. That reach matters because attention is one of the great economic assets of the modern age. But attention by itself is not enough. Plenty of businesses have traffic without quality economics. What makes Meta extraordinary is its ability to convert that reach into an advertising machine with enormous precision. If artificial intelligence helps show users more relevant content, time spent rises. If time spent rises, inventory improves. If targeting improves, advertisers achieve better outcomes. If advertisers achieve better outcomes, the platform becomes more valuable. That is not a random collection of features. It is a self-reinforcing system. The temptation with a company like Meta is to get distracted by whatever the spending line looks like this year. Yet that misses the broader picture. A business with this much engagement and this much monetization capability can afford to invest heavily if those investments reinforce the moat. You do not judge a fortress by the cost of the stone alone. You judge it by whether the walls become harder to breach. There is another point here that matters to me very much. When I am considering whether a company can remain adaptive for a very long time, I want a leader who has already shown a capacity to reinvent the product while preserving the engine. Meta today is not the same as it was years ago. Instagram is not the same. The forms changed, the features changed, the consumption behavior changed, messaging evolved, video expanded, discovery shifted, and yet the company kept finding ways to remain central. That capacity to change without losing relevance is one of the rarest managerial strengths in business. It turns time from an enemy into an ally. Now let me move from networks to brands, because branding is one of the most misunderstood subjects in the market. People throw the word around carelessly. They assume any company with visibility has a brand. That is not true. A real brand is not just recognition, it is meaning, it is repetition, it is reinforcement, it is cultural placement bought and defended over many years. That is why Nike stands apart. Apparel is full of examples of companies that looked exciting because they rode one category, one fashion wave, or one moment in consumer taste. Then competition copied the product, the novelty cooled, and the aura evaporated. That is what happens when a company builds itself on something narrow. It may survive. It may even have good years. But it does not create the sort of enduring compounding that comes from an identity customers continue to trust. Nike is different because it has spent decade after decade making sure the brand stands for aspiration, performance, and status in a way that competitors struggle to match. It does not simply sell clothing and shoes. It sells association. It sells ambition. It sells the feeling of being tied to winning, effort, excellence, and athletic achievement. That does not happen by accident. It happens because a company keeps reinvesting in the brand, in athletes, in sport, in innovation, in relevance, and in global distribution until the relationship between the consumer and the symbol becomes deeply ingrained. People underestimate how hard that is to copy. A product can be copied, shelf presence can be copied, certain designs can be copied. But cultural positioning defended over decades is a much steeper mountain. And Nike has done something else that matters. It has remained broad. It is not restricted to a tiny luxury niche, and it is not trapped in one narrow use case. It serves a global market that includes serious athletes, casual buyers, status buyers, and everyday consumers. That scale then funds more marketing, more innovation, and more staying power. It becomes a circle competitors cannot easily enter. That same distinction between a real franchise and a passing fad is why I pay attention to ELF beauty. Cosmetics is not a trivial business. It is a recurring behavior business tied to identity, routine, and personal spending patterns that repeat year after year. The question is not whether people will continue to buy beauty products. They will. The question is which companies can convert that truth into durable market position. What makes ELF compelling is not simply that it has grown. Growth alone can be rented. What matters is that it has built meaningful shelf presence and a reputation for delivering strong value at accessible price points. That combination is more important than many investors realize. There is enormous power in becoming known as the company that gives people quality without punishing their wallet. In a category crowded with options, affordability paired with acceptable or strong product perception can create a very durable habit. Once the products earn repeat purchase, and once the brand commands visible placement at major retailers, the business moves beyond novelty. It becomes part of the shopping landscape, and then management has an opportunity to do something even more valuable. It can widen the house of brands that matters because it lowers dependence on a single label and increases the chance that the company compounds through multiple channels of demand. When I see a beauty company moving from a single success into a broader collection of promising assets, I see a business trying to improve its odds of relevance rather than assuming one hit will last forever. The same broad principle shows up again in beverages, and that is where Celsius becomes interesting. Beverage businesses can be marvelous when they achieve scale because human consumption is repetitive. Distribution matters enormously, and brand habits can become very sticky. But that statement comes with a condition. You have to reach critical mass. If you remain niche forever, the economics and the staying power are much less certain. Celsius no longer feels niche. That is a crucial transition. Once a beverage moves from being something a few enthusiasts know into something that appears everywhere and becomes an expected option in stores, coolers, and clubs of distribution, the business changes character. It becomes less speculative and more structural. The consumer sees it often, chooses it often, and begins to think of it as part of the normal set. That shift is hard-won. Distribution partners matter, shelf space matters, brand visibility matters, repeat purchase matters, secondary brands matter. Once an operator starts to show it can build more than one relevant drink line, the case improves further because it suggests the company is not just lucky. It suggests the company understands how to build and extend demand. There is also an old truth in beverages that should never be ignored. The winners often enjoy a long runway because the product is cheap enough to repeat, visible enough to reinforce, and habitual enough to stick. If a brand gets into a consumer's routine, time can do a lot of work for the owner. That is why some drink companies became extraordinary businesses. Their products were not purchased once with ceremony. They were purchased again and again with almost no friction. The last of these examples sits in a different corner of capitalism, but the logic remains recognizable. Wynn Resorts is not a basic consumer staple. It lives in the world of luxury hospitality, gaming, entertainment, dining, and destination spending that might seem less predictable than shoes or beauty or beverages. Yet the right way to analyze Wynn is not to ask whether people will suddenly stop wanting premium experiences. The right question is whether the company owns irreplaceable positions in a category where the top end of the customer base continues to pay for excellence. The wealthy have always shown a willingness to spend on the best available version of leisure. They want the place with the strongest service, the cleanest presentation, the highest prestige, the strongest atmosphere, the most memorable experience. In that segment, the best property is not just another room. It is a status environment. It is where a customer goes because the total experience says something about where they belong. That is why premium resort assets can hold value far better than outsiders expect. A truly high-end property in the right market is not easy to replicate in substance, even when another company builds another large structure nearby. Real differentiation can live in service culture, design, customer mix, food, feel, and reputation. When a company becomes the destination for the customer who expects the highest quality, that relationship can last a very long time. Now, some people will hear these examples and think I am simply naming different industries. I am not. I am describing the same underlying idea wearing different clothes. Amazon wins because it embeds itself into habit and operates multiple compounding engines. SoFi wins if it becomes a long-duration financial relationship rather than a single product. Meta wins because it controls vast attention networks and converts them into precise economics while adapting over time. Nike wins because a true global brand defended by relentless spending is one of the hardest assets in the world to dislodge. ELF wins because value, access, and shelf strength can turn a fast grower into a durable beauty franchise. Celsius wins because critical mass in beverage distribution can transform a once narrow brand into a repeat purchase machine. Wynn wins because the premium end of hospitality rewards companies that create places people with money continue to choose. In each case, the lesson is the same. I do not want a company that looks exciting because it is hot. I want a company that still makes sense when the heat is gone. I want something with reinforcement. I want something that gets stronger when scale rises. I want something that can keep customers close without needing to beg them back every quarter. That is also why I spend a lot of time thinking about what to avoid. I avoid businesses built on one product with no larger system around it. I avoid companies that confuse social media noise. I avoid management teams that talk as though the future will be handed to them rather than built by them. I avoid brands that are visible but hollow. I avoid fads pretending to be franchises. I avoid businesses whose best years depend on the market remaining impressed rather than the customer remaining loyal. If you can teach yourself to separate those two worlds, investing becomes calmer. You stop asking what will be popular next month. You start asking what will still matter after the next cycle, the next panic, the next rotation, and the next wave of imitation. That is the discipline. A forever holding is not something you buy because you are too lazy to sell. It is something you buy because the business keeps earning the right to stay in your hands. It keeps expanding its moat. It keeps proving that relevance was not a fluke. It keeps turning time, scale, and customer behavior into stronger economics. That is why I never begin with price alone. Price matters. Of course it matters. Paying a sensible price always matters. But if the business has no durable logic, a cheap quote can become an expensive lesson. On the other hand, if the business truly deserves a long runway, temporary doubt can create the sort of opening that serious investors wait for. The market is often generous with those openings because it is built to obsess over what is immediate. I am trying to own what remains. So when I sit down and think about businesses I could imagine holding for a very long stretch, I am not asking which ticker has the prettiest chart or which story is making the rounds on television. I am asking which of these companies has built something that people are likely to keep using, keep trusting, keep paying for, and keep returning to long after the current excitement has moved on. That is the standard. It is a hard standard. Most companies will fail it. A few will not. And when I find one that combines habit, scale, brand, reinvestment, management quality, and room to deepen its economics over time, I pay attention, because that kind of business can make patience look intelligent. It can make time feel productive. It can turn the ordinary act of holding on into one of the most profitable decisions an investor ever makes. That is the kind of business I want beside me for the long haul. There is another misunderstanding I want to clear away. Holding forever does not mean refusing to think. It does not mean becoming sentimental about a ticker symbol. It means the burden of proof falls on the business, not on your nerves. If the business is still widening its moat, still serving a real need, still adapting, still allocating capital with intelligence, and still deepening customer attachment, then temporary market fear is often just noise. But if the original reasons for ownership were shallow, then every correction becomes terrifying because there was nothing solid underneath your confidence to begin with. That is why I do not like the lazy phrase that says all quality companies will obviously work out. Quality is not a decoration. It is a structure. It has to be earned in the numbers and in the behavior of the customer. Amazon earns it because convenience deepens and multiple profit streams reinforce each other. SoFi can earn it if it keeps turning members into a true ecosystem. Meta earns it through engagement, monetization, and adaptation at enormous scale. Nike earns it through global cultural power that weaker brands only imitate. ELF earns it by pairing affordability with shelf dominance and repeat behavior. Celsius earns it by moving from novelty into routine through distribution and brand adoption. Wynn earns it by occupying the premium experience layer in markets where the best asset keeps drawing the best customer. When you look at them that way, you stop seeing 7 disconnected ideas. You start seeing 7 different expressions of the same investing truth. Enduring businesses do not need the world to stay simple. They need the ability to remain important as the world changes. They need to be sturdy enough to absorb competition, strong enough to keep pricing or volume or loyalty, and intelligent enough to reinvest before weakness becomes visible to the casual observer. That is where many investors get hurt. They wait for proof that a moat is real after the moat has already become obvious to everyone. By then, the market often charges them dearly for certainty. The better approach is to study the structure early, think in years instead of headlines, and ask whether the customer relationship is likely to deepen rather than weaken. You do not have to know every quarter in advance. You have to know what kind of economic machine you are dealing with. And if you are dealing with the right kind of machine, patience stops feeling passive. It becomes a form of judgment. It becomes the willingness to let a superior business do what superior businesses tend to do, which is reinvest, defend, expand, and compound, while the crowd bounces from one temporary fascination to another. That is why I care so much about the difference between a company people are talking about and a company people are using. Talk can disappear overnight. Usage is much harder to break. Real routines, real relationships, real distribution, real trust, real prestige, real repeat purchase, real platform dependency, those things survive mood swings. They survive analyst noise. They survive the market's endless urge to turn every serious decision into a short-term game. If I can own a business that survives that circus and comes out stronger on the other side, I do not need it to be exciting every day. I need it to keep doing the quiet, durable work that eventually makes the numbers speak for themselves. That is how fortunes are really built, not by guessing what the crowd will yell about next, by owning what the crowd keeps underestimating until time makes the answer too obvious to ignore.